Okay, traders, let's get started. First and foremost, welcome to today's webinar event. My name is Sean Kozak, and I am the founder of Neural Street Trading Academy. I want to thank you guys for your attendance in today's webinar. I know there's lots of places you could be, and you chose to be here today with us, so thank you. That means a lot to us and our team. More importantly, we're super excited to go over some interesting concepts today with regards to momentum, breakouts, and divergence trading. Now, before I go any further, I normally like to start these events off by just letting you know, just make sure that I'm recording, yep. Letting you know that we are recording the event, and we will send out a recording following the time today so that we can make sure that if you can't stay for the entire event, you can at least watch the recording. Also, if you have any questions or you need anything covered in the event, just type them in the chat box, and if I don't get to them right away, I will. I'm not ignoring you, just normally staying on topic when I'm presenting, and then that way I can make sure that we address them moving forward. So before I go any further, can you guys just put into the chat box if you find that you're more of a directional trader or a non-directional trader? And that doesn't mean trend or breakouts. I mean, a trend is a direction, a breakout is a direction, a momentum is a direction. So there's a directional and then there's a reversal trading. Reversal trading could be fading, could be divergence, could be levels. Just, do you find that you're more of a directional trader or a non-directional trader? Just put that in the chat box while I have the disclaimer on here. And that will give me an understanding of, you know, the audience and who you are and where you're at. So we've got Gary says he's a directional trader. Mike says directional, Christian directional, Ray directional for stocks, both for now. So as you know, guys, the risks in the business, we don't guarantee profits. We can't guarantee anything. We're not here to do that. We're not in control of the markets. All we can control is our risk. So we're not here to provide advice, just guidance and education for products and services. Most of you guys are directional traders, okay? So I'll just share a little bit of my experience with you. In case some of you guys are new. If you're new and you've never been to one of my webinars before, welcome. You're in the right place. You know, I have a lot of experience working with a lot of traders. I've had definitely the privilege of trading with thousands of students over the years, and many of you guys have traded with me in the trade rooms, been in my events before, and some of you are new. And the big thing for me is I remember when I first got started and I was on the hunt for, I was just so passionate about trading, right? I was just so passionate about the markets. I was so passionate about learning this and succeeding in it. And then what became even more exciting was when I started to really see and understand how things were working and what was taking place. And that came with a lot of struggle. In fact, it came with a lot of, days where, I would ask myself, man, like, is this for me? Is this right for me? Is this what I really want to do? And I just kept going back to the concept of, I love it. And it makes me happy. And it's a passion of mine to be in the markets and to trade and to work with traders. And the reason I share that with you now is because I'm not here to give you any fluff or snake oil, right? As somebody who trades alongside a lot of traders and who educates traders, there's enough struggle in the business alone, never mind hearing it from somebody else, right? So we all know what that means. And the reason I say this leading the event is my goal here today is to help you become a better trader in any way possible through the concepts that I'm going to share with you today. I'm going to talk to you about some of the skills that I've learned over the years with regards to breakouts, momentums, and divergence, direction predominantly. The reason this is important is because a lot of you are on the path of becoming a good trader. Some of you are on the brink of actually getting there right now. Some of you are just getting started. Some of you are still in the struggle mode, and some of you are actually succeeding. Now, the reason that I say this is because in order to be successful, you need to pick a signature trade or a couple of them. Most people starts with one. And that's why I kind of led with that question, directional or non-directional, because that will help you narrow down your signature trades. The topics today that we're going to be covering are going to involve helping you understand what to use in the different types of signature trades. So if you're a directional trader, we're going to talk about some concepts that are going to help directional traders. If you're a non-directional trader, I want to talk to you about some things that can help non-directional traders. And the reason for this is, you know, I've had the privilege of being able to do this with a lot of students. In fact, you know, some of my best success stories come from some of the traders that literally just let go of all the things that weren't working for them and started to listen to some of the concepts that are unfolding. And so in today's agenda, I've got a bunch of stuff I want to share. We're going to talk about hybrid momentum. Okay, we're going to talk about confluence versus non-confluence. We're going to talk about the two different types of divergence. We're going to look at excursion levels, also known as OBOS, overbought and oversold environments. I want to talk about the signal systems that are generated by the VM system. So we've actually created signals for breakouts. And if you are a breakout trader, you could leverage those. We've also created signals for divergence. So if you're somebody that likes to identify divergence instead of drawing it manually, which can be a very daunting task to do it properly, we've automated divergence. And the big thing here is if you're interested in everything that we're doing, we'll give you a discount coupon code at the end of the event. What we do in the webinars is we normally give discounts on the products and the tools that we're using for these events. So if you have any enjoyment of the topics today and you like what we're doing, then we'll make sure that you get a deal at the end of the event. So that being said, we'll do some Q&A at the end. And if you need any assistance, please don't hesitate to put your questions in the chat box. So the VM system is a product on our website. It started as a very simple oscillator and it emerged into a very robust tool set. And that normally happens with some of the tools that we start with. Normally you start to realize the way in which things can be used, how to make advancements to them, and how to leverage them for different aspects of trading. Now, the reason I like the VM system so much, and the reason I like the velocity and momentum oscillator so much, is because it involves many different things that remove the need for me to have to use a whole bunch of other tools, right? Like, there's nothing worse than having to use a whole bunch of other tools on your chart if you don't need to, right? So it's about keeping things as clean as possible. Also is keeping things to, you know, learning and mastering one set of tool sets rather than having to master 5 or 6 different oscillators, right? I remember lots of times traders will, you know, they'll show me their charts and they got an RSI and a CCI and a stochastics and a velocity Momo and they've got Bollinger and they got all these different indicators and I'm just trying to figure out where the signal is, right? Where is your rules for the trade? So today we're going to keep it clean. And the first thing I want to talk about is the aspect of being a hybrid oscillator. Now, a hybrid oscillator is where we take two different oscillators and we merge them. So what you're seeing down here in the subgraph, okay, is two oscillators. You have a histogram, and what this is measuring is velocity cycles. In fact, it's actually measuring fast momentum. So you're going to be able to pick up every pivot, every move in the market. It's very responsive to price, okay? And there's pros and cons to that. It's really good for timing entries, but it's not something that you would use for major reversals. So fast momentum oscillators are something that you would want to use for, say, bounce trades. Something that you're looking for quick scalps in and out. You're not looking for big plays. You're looking to get in and get out. You're looking for timing, small little moves in the market. Where on the other side, what we've done is we take the MACD BB of the histogram. So what's interesting is that unlike standard MACD BBs, they need to be applied to an underlying oscillator. So we're applying the MACD BB to the actual velocity histogram, not the standard MACD. So this is the difference between just using a MACD BB, which is no special sauce, but it's the underlying engine that it's driven by. So when we use the velocity histogram for the velocity cycles, it's a much different indicator than just standard momentum indicators. And so the reason this is important is because we're going to be able to identify when they're moving together and when they're not. And that's really important, because if you're going to be a directional trader or you're going to be a non-directional trader, you want to know the concept of confluence. So what we'll do here is, well, first of all, how many of you guys use an oscillator on your chart? Is there anybody in here that's using oscillators on their chart? Just type a yes if you're using oscillators. Jean is? Yes? Anybody else using oscillators? Ray is? Jason is? Mohi is? Yeah. Okay, so the nice part about this, down here, the histogram is the fast momentum. The MACD BBs, it stands for moving average convergence divergence. So it's the MACD Bollinger Bands. Well, moving average convergence divergence, just so you guys understand what that is, it's the moving average convergence divergence of the underlying oscillator, which is the histogram in this regard. You can have a moving average convergence divergence on an RSI, on a CCI, on a stochastics. It's how you're applying it to the engine. So this is where a lot of traders don't understand, is that the MACD BBs is driven by it's driven by an engine, and that's where we want to make sure that you understand the difference. Okay. Now, when we look at this, we overlay the two on top of each other so that we can see how they work interchangeably with each other. So the reason that's important is because when you're in a state of confluence, okay, confluence is when you have a histogram and a BB all moving in this direction. Okay, you can see the confluence here. Okay, everything's moving together. Okay, that to me is very important for trend traders. Absolutely critical. I'm going to show you some large examples, because there's going to be situations where trends do not continue because A, they're on the wrong side of the wave counts, and B, you're not taking the wave counts with confluence. We're gonna do some wave counts together. We're gonna count some trend structures together, do a little exercise, and then what we're gonna do is we're gonna look at how the Momo confluence plays a big factor in directional follow through, because momentum is an oscillator, so price has to happen, but it can be a really big gauge of expectation. It can be a really big gauge of expectation, especially for intraday scalpers and trend traders. Okay. The same thing here for bearish confluence. You can see the thing about confluence is that we don't actually have confluence until right about here. You can see that there's this space right here. I call that the gap. And that gap is an indecision point. And I personally do not like trading trends when there's a gap in the oscillator. In fact, I will not enter a trend unless that gap is closed. As soon as that gap closure takes place, I know that I can expect follow through in both fast and slow momentum. Slow momentum is stronger momentum. Fast momentum is weaker momentum. You'll see the faster momentum always leads before the slow. And the slow catches up here, and then the move happens. Okay, so let me explain a couple things. You're not always going to have confluence. You're going to have situations where the oscillators are going back and forth. And we call these zero line rejects. We call these fake out breakouts. So this is where price comes here. You can see price kind of lifts up, breaks down, take a look where the BBs are. Take a look where this MACD is. There's this big space here. Okay, then we get some breakdown. Take a look here. We come up, look what happens. Big gap in the Momo, and they reject off the 0 line. Okay, same thing here. Tries to push up, reject off the 0 line. This is how you can understand what to expect for follow through. This would be considered a non-directional market. The buyers are having a hard time in these situations. So why is this important? Well, let's go to an example. Okay, this is a chart of the S&P. I've got 4 tabs down here. I've got momentum, obos, divergence, and termite. We're going to just talk about momentum for a second. Okay, let's go here for a trend. Anybody want to hear, give me the rules for an uptrend? What do I need for the rules for an uptrend? You need a subsequent higher high with higher lows, right? Yeah, you need higher high, higher low. Very basic stuff, right? Okay. Well, a lot of times you can have that. You can have that. Look, you could have a higher high. Got negative momentum. Say, okay, you got a higher high, negative momentum. Okay. Where the real aspect of continuation is when you can line price and confluence. So if we just sit here and we go price by price, you can take a look. We got a higher high in price. We got a higher low in price. Okay, you say, oh, Sean, well, we're starting to build an uptrend. Well, yeah, but there's no evidence that this trend is actually going to do anything for us. You understand where I'm going with this? The whole purpose of us understanding follow through, and this is just on any time frame, any market, it means no different. We can look at a range chart, we can look at a volume chart, we can look at a minute chart. The concept is that it's dynamic to whatever chart you apply it to. And what I'd want to see is I'd want to see a break of structure, pull back, and I want to see some confluence here. I want to see confluence because that's when I would believe that we could at least get a pop in a trend. Price makes a higher high. Okay. Do we have confluence on this pullback? Yes. Yes, we do. 0 line crosses 0. Green oscillator. We close the gap. No gap in the Momo. Okay. What ends up happening on this next pullback? We get a big push. Now, this is a 1 minute chart. This is scalping time frame. So we're not looking for big moves here. I'm just trying to demonstrate a concept. Okay. Let's go to another example. Another thing too you want to make sure is you don't take, I don't know if anybody here knows wave counts, but this is 0 to 1, pullback 2, wave 3, pullback 4. This is wave 5. I would not touch this trade. Would not touch it with a 10-foot pole. Okay. Let's go here to the downside. Okay. You see what happens right here as soon as we push this higher high in price? We make a lower high and then a higher high in price. Do we have confluence? Yes, we do. Okay. So if we're going to take a trend trade and you're going to get into a pullback, you have evidence to believe that the market momentum can support the direction. If you tried to do that and there was a gap in the Momo, you are gambling. You're gambling because what's happening is that you're in a situation where you don't know if momentum can give you follow through. Okay. Let's count the waves. 0 to 1, 2, 3, 4, 5. We won't touch this wave. Okay. And it's a good thing you don't touch that wave. I don't trade wave 5 pullbacks. End of story. Okay. We'll wait for another one here. We push up. Is there confluence here? Yes, there is. Yes, there is. There's definitely confluence here. We get a push to the highs? Yes, we do. What's happening right now? I want to share a little story here. What's happening right here? I want to talk a little bit about what the Bollinger Bands do, because the Bollinger Bands are a measure of standard deviation. So when you have Bollinger Bands, okay, there's an average in here. I have it turned to fluorescent so you can't see it, okay? And then you got the BBs. The BBs will come in here, and they might come here, and they might come up like that, and they'll come in here, and then they'll come up, and then all of a sudden, boom. Well, this is acting as support. This is acting as support. And then what happened here? We broke support. Now, when you hear the term Bollinger Bands, okay, Bollinger Bands, I want you to think standard deviation. Now, if you don't know what standard deviation is, it's the measure of statistics, and basically it's like, you know, you have a standard deviation to one side, standard deviation to the other, and what it's doing is that the Bollinger Bands are like an elastic, and it's like an elastic that you normally will want to revert back inside the bands. You know, if they break outside the bands, a lot of times it's a sign that the market is going to transition. So let's give you an example here. Let me show you an example how this looks. If I know that I've got here, okay, take a look at this. This one got above it, we stayed above it, stayed above it, we deeper pullback, right? We stayed above it, and then we came down here, we broke below. Okay, what happened when we get on the other side of that band? This becomes support. These are all levels of support. We break below it, it's now acting as resistance. So this is where we got to look at where those BBs are relative to the bands. And the reason this is important is because it's a secondary measure of statistical support and resistance. If I'm breaking below the BB here, outside of that Bollinger Band, I would expect weakness in price. And this is where the fast momentum kicks in. A lot of times what will normally happen is you will normally see a break of the BBs when the fast oscillator kicks in. And the reason this is happening is because we're measuring the fast velocity cycle. Normally we're measuring velocity cycle breaks of structure. And when you have breaks of structure met with momentum breaking down like that, okay, you can have breaks of structure and it doesn't quite give us that yet. You can see it didn't quite give it that here, right? We didn't quite have a break of structure there, okay? You can have a break of structure here and we don't quite have a transition yet. But when you see a break of structure like this, and we're breaking structure and we're breaking BB and we're breaking oscillator, you're normally going to see a bigger flush like this, okay? And that's just because we're losing steam in the oscillators. Now, what happened here? We come down to the zero line, okay? We're getting confluence. 0, 1, 2, 3, 4, 5. We don't touch the pullback. Well, that's the whole concept of the VM. It's a hybrid oscillator. So the VM integrates. The VM is called velocity MOMO, and the velocity MOMO is the histogram engine. And then the MACD BB is using that engine to drive it. If you took just a standard MACD BB indicator and you put them side by side, they'd look completely different. Because the standard MACD BB indicator is pulled from the MACD indicator. We're not using a MACD indicator here. We're using the moving average convergence divergence of the velocity cycle. It's a very different concept. It's a very different read. If I put a MACD on my chart and I applied the MACD Bollingers to the MACD, then it would be a completely different look, okay? So when you say, do you have both the MACD and the BB on this actual chart? No, the MACD is not on this chart. Yeah, so I just want you to understand that, Jean, because it's important to know the difference between the two. So when we break back up, take a look, we got a break of structure here. Okay. 1, 2, 3, 4, pull back. This one failed down. Okay, let's watch as this breaks. Now, today was a really oscillating range. Today was a very oscillating market. It was an interesting read. If you shake it to a 2-minute, you'll see a little bit of a different structure read. And you'll see it. Bigger the time frame, bigger the waves, bigger the momentum, bigger the velocity. Okay, Ray. If you guys would like to type all your questions, just go to 2. In your chat box, it says all panelists and attendees. Just choose to write your comments and questions to all panelists and attendees. So anybody in here that wants to write a question, just put all panelists and attendees by your chat window. Yeah. That way everybody can see the question. Okay. So does everybody kind of understand the importance of confluence? Because if we're going to trade a trend, and this is for all of you directional trend traders out here, okay? If you're going to trade a trend, but you're here right now and you're like, okay, I don't know that's going to happen yet, but if I've got my oscillator down here and I'm not really in confluence, there's a chance that this could fail. So the reason I always like to teach concepts of confluence is so that when you're trading directional strategies, if you have the discipline to wait for confluence, you will be in a much better place of probability because you're stacking more odds in your favor. Okay. So let's go and take a look now at a different concept called divergence. Now, when you study momentum, okay, when we study momentum, what ends up happening is a lot of times price and momentum will not operate together. And that's the concept called divergence. Now, drawing divergence is a very difficult task. So we've automated the drawing of divergence. Now, there's 2 types of divergence. The first one is differential divergence. Differential divergence is where momentum leads price. So this will be where momentum will start to show you signals that the market is slowing down before price does. Now, there's 2 types of this. Bearish differential divergence is when price makes higher highs. So price is making higher highs in price, and momentum is making lower highs. Okay. Now, the other side of this is bullish divergence, and this is where price is making lower lows and momentum is making higher lows. Okay, so you can see that momentum is leading price. This would be momentum would be leading price. Okay, now let's go and talk about the other side of the equation, which is hidden divergence. Now, hidden divergence yeah, Yudayan, I'll go over those questions in a second, my friend. Yeah, I'll go over those in a second. So hidden divergence is when price leads momentum. And price, okay, when we talk about price leading momentum, okay, we've got 2 concepts here. Bearish hidden divergence is when price is making lower highs. So let's say we're doing this, okay, but momentum is still making higher highs. And then bullish, okay, hidden divergence is when price makes higher lows, so like this, but momentum still making lower lows. And this is very difficult for you to see this in the market. It's very difficult to see this in real time. So what we do is we automate these signals because what we're doing is we're anchoring all of the different anchor points from the oscillators, and we actually measure the divergence on both oscillators. So we can have divergence on fast momentum. We can also have it on slow momentum. What do you think would be stronger? Like if you were planning to take a reversal trade using divergence, what do you think would be the stronger oscillator to use for divergence? Anybody have a guess at that? I normally like to just ask questions just to see if anyone's... The BBs. The slow momentum, Seth says. Yes, because the BBs are a slower oscillator, but they're stronger. So what we want to do is we want to think that, okay, you could have maybe small moves of divergence using fast momentum, but where the real big opportunity lies is when you get big divergence on the stronger momentum oscillator. So you can see here that we not only produce signals with arrows, we draw the automated divergence on your chart. And what we also do is we put racing stripes so that you can actually see the signal, okay? Now, I want to go in and I want to actually talk about that for a second. So when we talk about divergence here, okay, this is a 1-minute chart. We could look at it from different concepts. We could apply it to a range chart. Today was a very, very messy day, so it's interesting to see how this works. But I just want to kind of talk a little bit, though, for a second, because on range days, this is where divergence really, really works well. So when you think about divergence, so you have directional strategies, okay, trend, breakout, okay, momentum, non-directional strategies, you've got levels, reversals with structure, right? You got divergence. So if we're trading divergence, and that's a reversal strategy, we got to ask ourselves, before we implement any form of trading system, we should ask this very important question. Am I in a directional market or non-directional market? When we're in a non-directional market, we would be deploying non-directional strategies. When we're in a directional market, we should be deploying directional strategies. Okay? So today was a perfect example of a non-directional market. In fact, we stayed inside of a range, okay? We stayed inside of a range pretty much for the better part of all morning. Like, we're still inside that range. Now, this looks a bit messy, but let's kind of spread it out a little bit. Let's go to the open. And let's just, actually what I want to do is I just want to connect the highs off the open. We're gonna turn the signals off for a second. Just like this. Okay, and I've got the automated lines drawn here just on purpose, guys, because I could draw hidden divergence or I could draw regular divergence. In this situation, I'm going to turn off the hidden divergence because hidden divergence is normally better for directional. So we're going to go in here, we're going to go display options, hidden on, show div dots, histogram. So I'm just going to load the regular divergence. Give it a second to load. Okay. Now I just want to take the tops and bottoms of this range from 8 o'clock pre-market news. Okay. So just go here. And this was the low from the overnight session. So we're just going to connect the lows here. This was the low from the overnight session. Okay. And this was the, let's take a look at the Globex high, was up here. Okay, so that's pretty much the tops of that range from the Globex high in the overnight session from 3 o'clock. I normally measure the high from the open of the European session. And if we're sitting in here trading inside this range today, right, like literally, so what we would do is we would ask ourselves, okay, we would say self, where do you think we should be implementing the longs or the shorts? Well, it's not so much where, it's what can divergence tell us? And what this is telling us is that any of these areas where we're at the tops and bottoms of this range. So I'm going to connect the lows in here just a little bit. Okay, just connect all the lows and the highs of the range. Okay, so any of the signals that are inside of this range, I wouldn't touch them. I wouldn't look at them even as being as an opportunity. Okay, I wouldn't even look at them as being an opportunity. But let's go down here and take a look at what we're seeing here. These, to me, not valid. They're in the middle of the range. Even this one here, this one over here is closed. This candle closes in the middle of the range. So I wouldn't participate on this. But take a look at this one down here. This candle, this one is a very, very clean area. We're at the low of the range and we're getting solid divergence off the oscillators. Okay. This is where we would look at catching better reversal trades, because reversal trades are meant for reversal markets. This is a reversal market. Okay. This one here is closing in the middle of the range. What about this trade right here? This one here signals right here at the top of this range. This one here poses a much better risk reward from the concept of where we're at in the oscillating range, as opposed to these ones, right? These ones are sitting in the middle here. Okay, these ones are not valid. So when we start talking about how to use divergence properly, what this is telling us is that prices are making lower lows in price, but we're making higher lows, okay, here. Now, if we want to even simplify this down, let's take a look at how we can turn the divergence off a little bit and histogram divergence off. And just put BB divergence and see where the strength is. Okay, these are stronger divergence signals. Now, this is not using the oscillator histogram, it's using the BBs. Okay, it's using the strongest oscillator. So we've got 3 trades that I see that were clean at the opposing side of the range. Trade number 1, trade number 2, these ones down here, right here. Trade number 3, take a look at price made lower lows in price, higher lows in momentum oscillator on the BBs. Okay, at the low end of the range in a reversal market. Got another signal here. This is just BB divergence. This is not oscillator divergence on the histogram. Okay. And we're sitting here right now at the top of this range. So you can see the noise reduction by not applying divergence to every form of the oscillator. I don't believe in using the histogram divergence because it's too fast. It's really, really fast. And so what can happen is if you're using oscillators out of context, I think if you're going to be trading a reversal, let's just kind of write things down. Reversal trading. Am I going with the market or am I going against it? If I'm trading a reversal, does that mean I'm going with the market or I'm going against it? Yes, you're going against it. So do you think that can be harder or easier to stop a market or to expect to know where the market's going to stop? So if I know that already non-directional strategies are presenting a larger amount of risk than directional strategies, mainly because you don't know where the market will stop. Nobody does, okay? Then if we're going to trade a divergent signal or even reversals off structure, remember, this could be ranges. And what we're doing is we're using divergence in the range. So there's a few ways you can use divergence. If you've got a range in price, you want divergences at the opposing sides of your oscillating range. If you've got a profile, a giant auction, value lows, value highs. If you've got, let's say, a P or a B distribution, if you're profile trading, you would take divergence at the highs, divergence at the lows. There's many ways to apply divergence, but if we're going to trade a reversal, we want to trade stronger signals because they produce better odds. You might have less trades, but you've got better signals. Okay. So I see 1, 2, 3, 4, 5 divergence trades, 6. Okay. 6 divergence trades on the S&P 1 minute chart today. Now that's if you're trading 1 minute. If you're looking at range or volume or time or Renko or whatever, it's still the same concept, just a different bar type. Okay. Does everybody understand that? We would not want to be, now here's something really, really important. Okay. I'm going to do something different now. Let's say this market went like this. And then down here, you got the oscillator. And as it's going up, this is slightly coming down. That's called divergence. The problem with trading divergence in trending markets is that you're trying to stop a freight train. And when a train puts on the brakes here, it still goes here, puts more brakes on, here, puts more brakes on, here, puts more brakes on, here. Oh, we get to the station, you load up, train turns around, goes the other way. Right now, they're putting on the brakes here. They're putting on the brakes here. They're putting on the brakes here. They're finally putting on the brakes here. Then they might do this. Then they might do this. And then they do this. The problem with trading divergence in directional markets is that you're going to get a divergent signal here, and you get a divergent signal here, and you get a divergent signal here, and then you get a divergent signal here, and you're like, you take the stop out on the first one, you take the stop out on the second one, you don't take the one on the third, and that's the one that makes you money. You're not, directional markets are not meant for reversal systems. So the key of today's lesson on divergence is have the divergence at your arsenal when you're in the right conditions to trade it. Okay? Because if you're trading in an environment like today, it's the right environment for reversal trading. Do we normally see these environments like this? No. Normally we have these maybe once a week, once or twice a week maybe, or maybe a market will go trending for a bit and then it'll go sideways for a bit. It's our job to see the range. It's our job to see that. Absolutely, Richard. Divergence is meant for sideways markets, for large oscillating ranges. Yes. Yeah, not tight ranges. You don't want to be taking reversal trades in tight ranges because you never know which side of the range is going to break. But when they define a large oscillating range like this is where you want to trade divergence. Absolutely. Absolutely. And here's the thing. If you were drawing this manually, how do you know to take this anchor versus this anchor versus this anchor versus this anchor to connect it to here? We have all of our math. I don't like hit by the train, right? I'll just kind of explain a few things. There's difficult software to there's from a development perspective, just to help you guys understand. There's easy coding, there's medium coding, and then there's hard coding. Hard coding is really tough. Divergence, to get it right, really, really tough. Like, take it from somebody that's been in the development space for a very long time. I can assure you this, that when you are looking at divergence, getting the math algorithms right was probably one of the hardest things I've ever seen done. And it's because there's so many different variations of the anchor points to the structure. And this is where a lot of traders get confused. Okay, which one do I draw? Where's the higher low? Where's the higher structure? Which one is the divergence? Which one should I be using? You don't have to go through all of that guessing work because our software paints the picture for you. Okay. Now, the one thing I will point out, just so you guys understand, is that you don't want to be running divergence calculations across your entire chart because it can take up a lot of PC resources. So what we've done is we've basically put filters in here so that when we're coming in here, we can actually reduce the lag on your computer. So I can optimize for minimum speed, maximum speed, right? I can choose to do all of that. Yeah. I don't, hard coding has a different meaning. It's a cop-out to save time. Yes, absolutely. But the purpose of this discussion is to make sure that you know that you can have divergence across all of it or none. It's just going to take up more PC resources. And if you're loading lots of markets, we encourage just don't overload your computer because you're pulling a lot of, especially on tick charts. Take a look at the last divergence. They're going to come right down to the lows. It'll be interesting to see if we get divergence off the lows here. We'll go back to it after and see how they respect the bottom of the range. Now, I want to talk about one of my favorite concepts. Okay, does that make sense, guys? Give me a yes that you guys understand that for this environment. Give me a yes that that makes sense to you. Okay, perfect. One of the favorite topics I like to talk about is overbought and oversold conditions. Most people get started with the standard RSIs, the CCIs, the stochastics, because they're predominantly in all of the standard platforms, right? And I actually use a CCI for other indicators. I actually use a CCI because I find it a bit faster than the RSI or the stochastics. But what I find is that where we've done something very different is we layer the volatility based off the market's normalized cycles. So what we do with the velocity cycles is we're actually looking at this market's normalized ranges. So unlike an RSI or a CCI or a stochastic, which just looks at the output for the calculation, what we're doing is we're actually measuring the measured moves of the market. So this is a really exciting topic because it's very different than standard overbought and oversold conditions. It's actually unique to, because the scale will be different. Like if you're running it on, let's say, crude oil, the scale will be much different than, say, measuring it on a different market. And the reason I say this is because every market moves differently. So what we've done is we have 3 levels of overbought and oversold conditions, okay? And when we look at overbought and oversold conditions, we grid them here. As a directional trader, we have room to move between these locations. As a reversal trader, we can start to think that we're starting to get extended up here for the shorts, to start planning shorts. Down here, we're starting to get extended down here to start buying, okay? And the big thing for me is discussing what I would use it on. So I personally do not like to use the overbought and oversold conditions on the histogram, unless I'm just bounce trading for quick scalps. Like we're talking very, very tight scalps. However, remember we talk about the difference between a bounce trade, small objectives, and then a reversal. This is a market rotation. So a reversal is, say, this, all the way down. A reversal is, say, this, all the way up. A bounce trade is these little things in here, right? Like these little moves here, like these little bounces. This is a reversal to go all the way up. That's a reversal to go all the way down. These are big rotations in the market. So there's a difference between when to expect a rotation versus when to expect a bounce. Now, as a scalper, you might only be looking for a bounce. As a directional trader, right, I would want to know if I'm getting extended. I'd want to know how things are working. So let's go in here to Obos for a second. Okay, I'm going to just go in here and I've turned the oscillator to, if you notice, I removed the histogram. I just turned it off because what I want to do is I want to start mapping out how the market works when the BBs get there. This is the fun part because the BBs are much stronger than the histogram. So when we look at where we can expect reversals, okay, I want to know when the strong oscillator is getting extended versus the small little bounce trades, okay? Now I want to point out two things to me that really kind of point out to me. When we start looking at when price got up here, you can see when price gets extended here. Price got extended here. We didn't really get extended in the middle in here, did we? Yes? I want you to pay attention to how this looks in here. You can see the divergence on the low. You can see the divergence here. Okay? I want you to see, you can see the divergence here. Divergence coming off over bought conditions. That's really important to me. When I have divergence coming off of an overbought condition, that's where I would expect major moves in the market to happen. When I see these excursion levels versus, okay, when I see this, let's go back and find another example. Let's just take these out. Let's go in here and find a different aspect of divergence. Great example. Right here. You got price making higher highs, but you got price making equal highs in momentum at an overbought condition. What happens? Price drops down. Okay? These types of things are important for reversal traders to understand when we're extended. Okay? Look over here to the top. When price gets into these locations where the BBs are oversold and overbought. Okay? Look what happens on divergence. Lower low, higher low coming off of the blue and the green. Push back up. These are the things that you would look at as a reversal trader for clues to be able to see when you can time your entries better. Not looking so much at every single situation. Look what happened here on the lows. We're going right down to the lows. The BBs are oversold. I'd love to see them push a lower low and this to be higher low because I'm coming off of an oversold condition on the strong oscillator. I can assure you that the fast oscillator is probably way down here right now. But that's not the most important part to me. The most important part to me is when I see this transition to the other side, or when I see the BBs break above that upper band, and we're sitting here like that, that's when I know that this is going to start to lift, because the BBs are using the Bollinger as support and resistance. Same thing happened up here. If you take a look at what took place in this range, price come up over here. As soon as price came off of that location, you see how this was right here? So we broke those bands coming off of the top of the range, off of an oversold condition, or excuse me, overbought condition. That'd be an interesting play for us to start planning the entries here. Okay, price came back up. Look when they broke back down again the second time. This was interesting. This is when this market really showed us it wanted to drop. Double top, divergence, they broke the bands coming off overbought conditions. We're still at the same location of support though. That really tells us that this market's likely to drop. And sure enough, it dropped from there. It dropped halfway through the range. That's a trade right there. Or right to here. Okay. So the reason I'm sharing this with you is because for a very long time, I used to just look at the histogram and I found it to be too fast. And then I started looking at it on the BB side of things because the BBs are such a stronger oscillator. Now you see how we're making lower lows in price here in real time? We're still making lower lows in momentum. We're testing the low of this range. If this BB breaks above the upper band here, and we're sitting here at the bottom of this range, this would be an environment where I would expect the market to start to try to lift, because we're extended at the bottom of a range, right? And I'm waiting for the oscillator to tell me the clues of where the market's likely to transition. I would not expect this market to show me any type of strength yet until two things. I need either divergence, which I don't have, or I need a break of the Bollinger Bands, because that's the sign that we're changing standard deviation and we're going to support on the bands. And that's when the market will normally lift. Does everybody understand that? And the reason this is super important is because I'm in an oversold condition on the strong oscillator. The strong oscillator is a very important oscillator. It's not a weak oscillator. Okay. And this is to help the reversal traders in here, because reversal trading is harder than direction. Reversal trading is much harder than direction. If we go back to the direction, it's easy to see the confluence. You got lots of room to move. 0 to 1 to 2 to 3 to wave 4 pullback, they flushed. Normally it doesn't happen like that, but okay, we'll wait and see. See where this oscillator is? This is on the 2 minute. Let's go to the 1 minute. You see where this oscillator is? You see where this oscillator is? Lower lows here. You see where we're getting still. You see where the fast oscillator is really extended. Okay, we're down here deep at the lower end of this range, right? Take a look at the trend direction. 0 to 1 to 2 to 3 to 4 to 5. I would not touch that pullback with the 10-foot pull. Okay. I would really love to see them push a lower low here as this comes in like this. That's when I know this range is going to hold here and start to push to the strength of the upside, right? But this is the point. This is the concept of looking at using a tool to tell you what to anticipate out of the market. Okay. We don't have divergence yet. I would wait to see if we get some type of bullish divergence in here. It would be nice to see. Okay. So a couple things I want to talk about is we've integrated for the NinjaTrader platform system plans. These system plans are to understand the signal generation. So we actually provide entry signals with stops and target locations. All you need to do is decide the time frame and the bar type you want to use, and then also look at the system you want to use. We have a momentum system, which is a breakout system, and we also have a divergence system. So what we've done on the Divergence system is we just plot arrows or stripes. And we also have the ability to control trade plans. So you can map out your entry, your targets, or your stop losses. So it's just nice. It's just kind of a pre-planned system for you to be able to see the entire trade plan in advance, right? And we also have a breakout signal. A breakout signal is breaking structure. So this is basically when we take out structure with confluence. So this is more of a confluence signal on breakouts. A lot of traders will trade breakouts in directional markets. In today's type of environment, I wouldn't touch breakouts even if you pay me. Not a chance. You only trade breakouts in directional markets. So that's a great example of today is not an environment for breakout trading. Today would be an environment for divergence trading. But what's nice about all this is it's all included in the same indicator. So the reason why I call this the momentum oscillator on steroids is because if you go in here and take a look at the divergence, I can turn the signals on. So I can go in here and turn the regular divergence on, okay? Okay, I can turn on the trade plans. I can turn on all the signals, right? If I want to put all the plans on here, everything I need to do, okay, I can do all that if I want to put them on here. Turn off the racing stripes. Okay, I normally just like to look at the racing stripes. There's the trade plan if I wanted to. Depends on how I want to set the stops and targets up, you can do all that. But the big thing for me is just knowing what system plan I want to run it on. Like this is a divergence signal, so I would trade the divergence signals. Now this is showing every divergence. So this is trade plan is hidden, regular divergence, hidden divergence, none. Okay, and this is basically reading all the divergence signals. Okay, if you wanted to trade the BBs, right, then basically because what's happening here is we're actually making divergence on the histogram here. And this is why I say I don't like to use the divergence on the histogram as much. Like, look, we're making divergence here. That's why you're getting a signal here, but it's not, see, they're lifting, they're breaking the BB. So this would be the break of the band at an oversold condition at the low end of a range. This is where they're going to try to lift up the offer. Okay. So the reason I'm sharing this with you is if you like the signals, you can turn on the racing stripes. If you just like the arrows like this, we already produce signals just like that. It just depends on how you like visualization. Now the breakout system, you don't trade breakouts in non-directional markets. So this is a market environment where you're going to get signals in many different places. Not necessarily you want to trade every breakout, right? But the breakout signal is what we call the termite signal. And the termite signal is basically just looking at breakouts of structure. So when we break out a structure like this, okay, and we have a breakout of structure and we have momentum confluence, we'll get a signal called the termite and we'll get breakouts. Now, like I said, I don't like to trade breakouts, right, in every environment because we're not in a directional market. So you never know if they want to break out or if they want to suck you into the middle of the range. Where you want to trade breakouts, okay, and they'll bring this back, is breakout trading is a directional strategy. So in an environment where you're in a de-oscillating market or in a range-bound market, you want to trade reversals. In a P auction, a B auction, uptrending, downtrending markets, you want to trade the breakouts because those are directional strategy. Works with every chart, only on Ninja at this time. I do have the VM lean working on TradingView, but I don't have the divergence in there yet. We're still coding it. So I'll give you an example of what it looks like on TradingView, just so you guys can see for those of you that are ever using any other platforms. Okay, and if you go in here to TradingView, I'll just show you what it's looking like. We're almost ready there. We're almost done on that side of it. So we're actually adding this onto the TradingView platform. This is the VM lean over here. You notice how the bands are moving? It's because technically that's the way that it works. They're dynamic oscillating cycles, because I can turn that on inside a Ninja, right? So these histogram cycles, these velocity cycles move with the market. So if we go back over to NinjaTrader, right, I can go in here and turn these overbought and oversold conditions to dynamic. See? And that's why you can choose to fix them or static. This is because they're not fixed levels. So this market is going to move because it's measuring the measured moves of the market. This is what makes this such a unique indicator, because it's not fixed like just standard calculations. The measured moves change. The measured moves change. So we're not going to sit there and force an oscillator to just be static every day when the market's different every day. You can't say that the market's going to be the same every single day. How can you say that the indicator should work the same every day? You can't. That's why I've never changed using this. And if I ever use a different oscillator in the environment that we trade, it needs to be driven by these engines, right? And take a look what happened. Just like I was suggesting, we broke the bands right there. Oversold condition at the bottom of a range, right? We're not in a trend structure yet. So if we go back over here to this environment, this is the fun part about confluence. Fast markets are moving up. Slow markets still got a gap to close, yes? I would not be participating in a directional move until we made a structure change and I seen that we had no gap closure. I need to be above the 0 line. Then I would look at participating for a trend trade to the back to the top side of the range. Because now I know that the market's actually going to give me expected follow through. What's likely to happen, because this is a fake out environment, they might come up, reject off the 0 line, put in a lower low on divergence, and then rip straight up. That's the concept of reading momentum oscillators. It's one of the most powerful things you can ever do, is being able to understand the tool set that is driving the condition that you're reading. Because now you're not having to force a trend trade, and you don't got to get too excited about the reversal. Reversal's not ready yet. Does everybody kind of get that? Let's go back in here. So we got a couple questions here. We'll go over them in a second. So for those of you, okay, for those of you that have never been to an event, did you learn something today? Did you learn anything new today that you didn't know before? Jason's asking, Ninja, TradingView, and Thinkorswim. No, not Thinkorswim. We'll never code for Thinkorswim, Jason. Unfortunately, they're just too, their platform's too restrictive. Yeah, Forex has a lot of fake out breakouts. Oh, absolutely. And you never need to worry about being on the wrong side of them. Yep. You never got to worry about being on the wrong side of a fake out breakout when you understand confluence, right? Because confluence will tell you if the breakout's likely to continue or not. Okay. Now I'll show you an example of a trade that I took today on the euro. It wasn't a huge trade by any means. I took it on the 2-minute actually. And I didn't get much out of it because I was at the end of my wave count. And it was a time of day, it was really tough. But at this time, there was a trend in here. There was a trend average in here and was a pullback into the 20 and the 50 at the same time. Where was I with confluence? Do you see it? I had confluence. And this was the first time where I had an opportunity to engage a pullback, and I was on wave 4. So 0 to 1, pullback 2, 3, 4. Okay, they absorbed a bit. My stop was below structure. They absorbed a bit. Okay. They absorbed a bit. They didn't take my stop though. I got a little concerned because I thought they were going to break structure, and they came up and they got my target. I wasn't looking for a big trade on that, but I used Confluence to help me with that position. Okay, I used Confluence to help me with that position. And the only difference between this trade and the reason why the reason this gave me such heat on this trade was because it broke structure on the 1 minute. It gave an ABC pullback on the 1 minute before the push. And that's the reason why we look at 2 different time frames in our trade room. We use this tool in our trade room heavily. Yeah, heavily. Okay. So I got a poll to ask. Okay. So I'll go over some questions in a second, guys. Okay. Years ago, we started with the VM divergence indicator. And what we did was we integrated the system engines. So what we did was we created the signal generators for divergence signals, breakout signals, trade plan components. If anybody in here has the old version, okay, and you're interested in getting the update for the VM system, there's a different price because it's just an update fee. It's not an actual new purchase. So if any of you guys are using the old oscillator, the VM divergence, because I do recognize a lot of old names in here and we do appreciate your business. If anybody in here has a desire to get the new signal generators with the old VMD, I'm going to run a poll in here, okay, and just run this. If you do not own it, just put you do not own it. Because it's a completely different offer than just say somebody who doesn't have any of it, right? Because if anybody in here has the old VM divergence, the original from the past, okay, we'll give you a different discount for the upgrade because it's just an upgrade fee. We have an upgrade price for the system. And that way you'll get all the signals, you'll get all the actual VMD system generators, everything that comes in the 3, because it's really actually several different indicators. If you notice, I have different tabs, and those different tabs are just because I just have the different indicators applied on each tab. But you can use the main one, and ultimately it will basically give you all of it. So yeah, so let me, while you guys are asking that question, okay, I'm going to go over the pricing. Okay, I'm going to go over the pricing, and this is for new purchases only. This is for new purchases only. For anybody in here that's interested in does not own the VM Divergence software. For anybody here that does not own the VM Divergence software, okay. So I'll just give me a second to run that poll. I'm going to run this poll for another 30 seconds, guys, and then I'll close it. So if you do own the old VM Divergence and you would like to upgrade it to the new VM system, we'll send you a discount coupon code, and it'll be completely different price point than say, because you've already bought the original base engine of it. So Ray, great question. So while your guys are answering that poll, I'll just show you the tabs. The VM lean is just a VM lean. It means velocity and momentum lean. It doesn't have any of the divergence calculators in it. So it's just the confluence aspect for directional trading, okay? Every indicator, every VM lean or VMD has the OBOS, the overbought and oversold conditions. So no matter what indicator you're using, you're always going to have that. It's in every one of them, okay? But you'll notice down here it's got divergence. You see where it says VMD up here? The VM divergence has a divergence component, okay? Same with the breakout. It's the VMD has the breakout. And it's actually the same indicator. So when you purchase it, you get all of it. It's just whether you want to use divergence. Like if you go in here and I take a look here, I'll show you. You see down here, when we go here to the VMD section, You get all of it with the VM system. For those of you that, like when you purchase, you get all of them. It's not one indicator, you get all of it. The only difference is the VM Divergence is all in one, so you don't need to apply all of the different ones to your chart. It's like if you're planning on using the confluence and the divergence and the breakouts and everything on your chart, you would apply that. If you just want momentum, you would use this, right? If you just want divergence systems, you would use this. If you just want the momentum system, you would just use this. It just depends on what you're planning on trading with. And it's really just to save you PC resources, because when you load the all-in-one, it's just a little bit heavier on your computer. That's why we always implement these optimization parameters to make things faster for you. Okay. So I hope that answers your question, right? So let me go over the questions here. Thanks for guys for answering that poll. Okay, thanks for answering that poll. So what I'm going to do is I'm going to go over pricing for you guys, so that anybody here that does not own the software, can take advantage of a discount. This is for new users only who does not own any of it. Normally we retail the set of oscillators for $18.95. That's all 4 of them. Okay, and what we'll do is we'll take $800 off the cost of it. Okay. And it comes with an annual maintenance fee. That's for upkeep for platform changes and bug fixes and any updates inside of the code for bugs and stuff like that. We do that annually for all of our software. That comes with 2 computers, so you can apply a laptop or a desktop. We can swap them out if you ever change. User documentation, usage and settings, training videos. We can install it for you if you're new and you're new to Ninja, or you're not familiar with the code, or you're not familiar. We can definitely get on your computer. I have an in-house support team. We just book a meeting with us. We jump on your call and we set everything up for you. And it's available on Ninja 8 only at this time for the full package, because we're still coding for TradingView and it's not finished yet. So now we'll run this promotion for a couple days, so we can definitely get you in tune with the install and get you set up and running. I'm going to give you a link here, guys, for those of you that are looking forward to taking advantage of this. Plus, we trade with this in our trading room. So can you guys see the link? I'm going to put it in the chat box here. So I just put the link in the chat box. You guys can take advantage of that. I'm going to go over some questions now, because I've got some questions in here from several traders. Okay. So Jonas says, I don't want to, let me see here. Will you offer a longer, more in-depth step-by-step guide and insights into these indicators? Yeah, so that's a great example. So when you purchase the indicators, UDN, there's video training, detailed user documentation, and we have an in-house product specialist, Jeff. He can easily get on a call with you and go over the tool sets with you if you need some assistance. Yeah, we can definitely do that. Yeah, there's definitely a lot to absorb, and you just want clarity and confidence. I totally couldn't agree more. Yep. And we have that, so we can definitely help you. Jonas says, I don't want to make a comment until I finish all the educational material, because sometimes I need direction along the financial concepts, so pardon my silence. No problem, Jonah. You're in the learning process. You're in a great environment. Richard says, divergence works well in sideways markets. Yes. Muninder says, what are the percentages being used for support and resistance lines? They're not support and resistance lines. They're measured moves, Muninder. So they're actually measuring velocity cycles. So UDN says, wants to know what platforms it's available. It's available on Ninja at this time. It will be available on TradingView as soon as we're done coding it. It works on futures, Forex, and stocks. Any data that Ninja provides for you, it will work. So Rob says, I don't know futures. I'm an options trader. How long do you estimate it will take to learn this? Hours per day, days per week? Not a long time, because the user documentation is very detailed and the training videos go through it. Plus, if you have questions, we can easily get you on a call with Jeff, who's a product specialist, and he can go over the details. Like if you're using different time frames, okay? If you're using different time frames, or you're looking at stocks on bigger picture, daily charts, hourly charts, 240-minute, the same concept applies here, because it's dynamic to whatever chart you apply it to. It's like momentum oscillators are completely dynamic to whatever market or time frame you apply it to. So everything works the same way. Yeah. So if you're an options trader and you're looking for divergence in big ranges, absolutely. Or you're looking for confluence in trend trades, absolutely. Breakouts in trend trades, yes. So he says, I need a commitment level to make sure I can commit. I have a Ninja license and fee that don't know how to use it. Rob, if you're interested in using our tools and you need a little assistance with Ninja, just send us an email. We'll get on a support call with you. We'll get on a product call with you. We'll get you set up. We got training videos, YouTube channels to help you set up away. We're all set. Does the termite strategy only need the VM system? Yes. If you're only using the breakouts, you do not need the divergence on. Yes. If and when I leave my Thinkorswim account, I'll definitely seek you out. It's just that the learning curve on any platform is an investment, and I'm making money most days anyways. Yeah, not a problem, Jason. Hey, like I said, we're a trading academy, so we're not going anywhere. In fact, if you just want to come in and learn what we're doing, let us know. Guys, did you guys enjoy the event? Let me put the link in here. I hope you found this informative. You've learned a few concepts that can help you along the way. I want to thank you for your time. Thank you for joining me. You know, hopefully you guys had a good day trading, and if you didn't, you're in the right place to learn how to become better. We're an email and a phone call away, guys. If you need anything, let us know. And yeah, I enjoy teaching these concepts, guys. I want to help you guys become better traders. So if you ever need anything, we're an email and a phone call away. I'm going to get Jeff to follow up with everybody that filled out the poll to request those discount coupon codes for the upgrades. And any of you guys that were new users, take advantage of the $800 savings. It's a pretty big drop in price. So we'll talk to you guys soon. Thank you guys for being here and have a fantastic evening.